Airlines trick you every 10 years. 9/11, the GFC of 2008, COVID. So 10 years from now, what's it going to be?
What was the moment you realized that how you were investing your W-2 income wasn't actually building the freedom that you were working towards?
I flew with tons of captains and other pilots that wanted to invest in real estate, but they just didn't want to actually do the work.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christiansen, along with our co-host Anthony Faso, and today we're joined by Ryan Gibson. Ryan spent 17 years as an airline pilot flying for Delta and Alaska. And while most of us were watching movies on layovers, he was quietly building $1 billion self-storage empire on the side. Today, as a co-founder of Spartan Investors, he leads a portfolio of over 43,000 storage units across 15 different states. And he's here to show you how everyday investors can get truly passive exposure to one of real estate's most resilient asset classes. Quick note, Spartan Investors is not affiliated with Spartan Invest, the turnkey rental property company. Two great names, but two completely different businesses. Ryan, welcome to the show.
Thanks. Appreciate the nice intro.
Yeah, absolutely. And we're excited to have you. And we're even more excited to bring you back on July 15th, where we're going to be doing our triple play. So today, what we're going to do, kind of stay at a high level, and then we'll get into the details on the 15th. So Ryan, if you're all right with it, man, what do you say we kick this off?
Let's do it.
Awesome. Ryan, one of the things I love about kind of your stories, your background, is you went from an airline pilot to building $1 billion self-storage portfolio without quitting your day job. What was the moment you realized that how you were investing your W-2 income wasn't actually building the freedom that you were working towards?
Yeah, I think it really came out of diversification. I really wanted exposure to real estate. And so I kind of did what everybody thinks to do, which is go out and buy a bunch of single family homes. And so I started doing
Usually the first step.
Yeah.
usually the first step, right? Like go out and buy single families. And a lot of people think like, oh, this is going to be passive income, they're turnkey rentals. And what I quickly realized is like you're always responsible when you own it and you operate it. Doesn't matter how good your property manager is, you're still an asset manager, you're still having those calls. And I remember thinking, I'm getting a great ROI on these properties. Like I can brag about the percentage that I'm making on my dollars invested, but my ROI on life was just completely terrible. I was, bogged down on these properties that were making me $300 a pop, per month, maybe if I was lucky. But then I was, dealing with eviction decisions or financing decisions or repair decisions, just something always wrong. It's just kind of ruining my day to day, like good vibes of, my day is going really well. And then I get a call that, the roof is leaking or I have to make a decision on, this or that. And just as a high income earning professional, as an airline pilot, that's just not really what I wanted. But I realized there was this amazing opportunity where I flew with tons of captains and other pilots that wanted to invest in real estate like wanted the exposure because it comes with great tax benefits and great diversification, great cash flow. But they just didn't want to actually do the work and they wanted it to be truly passive. So kind of a light bulb went off and I said, I can go build a company that serves people like this and give them exposure to real estate. And 1,500 investors later and, hundreds of pilots that have invested is, kind of what we came to with this. And, I can get into why we picked storage, but, it's like, we started flipping houses and building condos, kind of like, again, what everybody does as a business, but we quickly went into self-storage and we realized how scalable it really was.
I'd say, Ryan, a lot of our listeners are high income earners, right? Ironically, that we have a lot of them that are pilots or business owners or trying to get to the start of business, right? And they're accumulating money, but a lot of them feel like they're on a treadmill, right? In your experience, what's a core mistake that keeps these high earners busy but not free?
Yeah, I think, it always starts with kind of the end in mind. What do you want to really get out of something? I think people, if it's income replacement to sunset a job, then I think that, a distraction on things that don't contribute to that would be something that people do. And they start focusing on things that don't matter. And I think just getting really clear about your goals on what your path is to get to what you want, I think is really impactful. Like I think some people have a goal to get off the hamster wheel and quit their job. And they start doing things that maybe are better suited for a part-time real estate investor. Sometimes people realize that they don't really actually like real estate investing, and maybe they enjoy their job and they want to be more passive. I think people underestimate how long it takes and how hard it is. I think the old joke is like, you know, I quit my 40-hour a week job so I could work 90 hours a week as a business owner. And I
True.
and
Yeah.
and I think there's a misconception that, you can just work a couple days a week as a business owner and have this amazing life. And I think that also is very distracting when you're first setting up your business, and even to today. I mean, it is a lot of work, but it's really rewarding. And I think setting the right expectation for, the best thing about being an airline pilot, and you'll ask any airline pilot this, and they'll probably have a similar answer, is you put the job away and go home when you're done. You fly the plane, you get home from your trip, and there is no TPS reports to do. You go on vacation for a month, you come back, there isn't a pile of paperwork to do. Maybe you have to check your NOTAMs and your file or something that takes a half an hour. But other than that, like, you do that when you get to the airport. It's a really good job. And so I kind of leveraged the fact that you could do a lot of work on the overnights and the downtime that you have,
Mm.
and you can build, something substantial. And I think you kind of have to look for those right opportunities to do that. But don't be fooled. Like, I run a podcast called Passive Income Pilots, right? And it's funny, it's kind of a misleading podcast because it's called Passive Income Pilots. And we always tell our listeners, like, you need to be very active to get your passive income actually working for you, right? Like, you don't just like, it's not just passive right away. Like, you still have to do a lot of work finding these opportunities, investing, accumulating cash to actually do the thing that you want to invest in. So I think just getting your expectation right is a big deal.
Ryan, you made a comment a minute ago on how you guys ended up in storage, and it made me think of, I think it's one of the articles that you guys had on your website. It was talking about how the industry is been strong, but it's also growing. And so as you're talking, I just went there and you said that on the website it says that the US self-storage market reached 47 billion in 2026, and it's projected to grow to 57 billion by 2031. Is
Huge.
that why it was so attractive to you guys, or what else helped you guys decide and to land on self-storage?
Well, I'm a millennial, 42 years old. I thought that self-storage in my 20s was probably the most silliest asset class to get into, because as a
Yeah.
millennial, I'm thinking like everybody is just getting rid of their stuff and investing in experiences. And so what was interesting, the story about how I got really attractive to it is, like, I got married, started having kids, and I had a renovation at my home because we were getting ready for the birth of my son. And I moved all my stuff from my basement out to self-storage to renovate my basement. And I was only I thought I was only gonna be there for 3 months, and, 15 months later, because the renovation inevitably goes goes longer than you think it does. And the owner at 6 months, the owner of the self-storage unit I put my stuff in, raised the rent from $100 a month to $120 a month. And I kinda got a little irritated, right? I took it, personally almost, and I called around and I tried to find another unit to move my stuff into. A, there's nothing available, or B, it's at a higher cost. And then I started thinking, what is this industry? Because I thought it was kind of silly, but here I am renting it because I'm having a life event.
Yeah.
And I realized that 70% of the people that rent units are going through some type of life event. And it's the 4 Ds, right? Death, displacement, downsizing, and divorce. And I like to throw two more Ds at that, actually, which is disease, because COVID made a ton of people use self storage. And the other one is diapers, right? Because I was having kids, and that's what made me actually need a self-storage, because I was having a life change. And so that just put me and my business partner down this path of, what is this industry? And so we kinda looked at, who are the big players in the space. We realized a lot of mom and pop, owners out there. Actually, more than 60% of the industry is actually still owned by mom and pop, individual owners of properties, and just saw a massive opportunity for consolidation. So we just started going out and aggregating a portfolio that eventually gets, consumed by the big REITs, Public Storage, Extra Space, or CubeSmart. Yeah, and so I just love the fact that it was easy to own, easy to evict, easy to maintain. We have no tenant landlord laws. We don't have there's restrictions, we don't have to put somebody through an eviction or anything like that. We have the auction process, so we can lien your belongings and sell them for the rent that you owed us and get our unit back. And that's just a really compelling reason for us. We didn't want to deal with kicking people out of their dwellings. That was not something that we really enjoyed doing, like removing somebody from their home. Well, with storage, it's just your stuff, right? So it's not as big of a deal. So that just really kind of got our appetite going for the industry.
Ryan, first of all, you made me feel old when you're telling me that you're a millennial. Okay. But
Sorry.
I don't know when that starts, but you don't look like a millennial. Definitely not acting like one, but I appreciate it. When I was wondering how we can add another D that would fit into Cameron. Cameron has a self-storage unit for his Paul Mitchell products,
Oh, that's right.
and
Yeah.
they're like temperature controlled,
Yep.
just to keep that
Yeah.
hair mousse,
That's right.
at the
And a
right. It gets
security
hot here,
guard.
but
There's a security guard that walks around,
Well,
keeps an eye. Yeah.
as a fellow hair connoisseur, I'm a gentleman of great hair.
Yeah.
Yeah, I can relate, man. I mean, you got to be ready. You cannot go a day without hair products, and having a storage unit's an excellent idea.
I mean,
D
yeah.
though, I don't know. I don't know. That's tough on hair
I'm
products.
gonna work on it, and maybe on the webinar,
We'll have
or maybe on the webinar, we can ask the audience what would be another D to describe Cameron's
No, yeah,
affinity
that sounds fun.
for
for
Yeah.
hair.
that silky smooth hair. But
Yeah.
back to the podcast, right? But
I've got one. If yeah, I'll get us back on track. Is that Ryan? I think most of our listeners understand kind of self storage as an investment, but how would you describe like what an actual syndication is and what makes it like a self storage specifically different from like multifamily deals that a lot of people are pitching right now?
Yeah, I think I like to say this for syndications. Like syndications are just partnerships with an operator, right, or somebody kind of running the deal. So all the semantics around it are accredited investors, and some have cash flow, some don't. Some have more upside potential than the more stabilized ones and things like that. So I think that there's regulations and things that we have to follow. That stuff is all the same. I would probably compare it most similar to multifamily in terms of like economics, expecting a 15 to 20% annual rate of return with some cash flow along the way if that's an existing facility. I think as an industry generally we trail multifamily cap rates by 75 to 80 basis points, just shy of a percent of cap rate. But yeah, no, I mean, I think it's very similar. We get depreciation, so you can do a cost segregation study on a self storage and do bonus depreciation on that, and you're probably looking at around 30% of your investment's going to get a tax break in the first year. Multifamily might be a little bit better because of the appliances and some of the more fixtures inside of the individual units, but yeah, overall, I'd say there's a lot of similarities. I think where it's different is, this might not matter to the investor because the investor is not doing the work, but I would say self storage is very much a retail style business because we rely on customers within a 3 mile market, just like retail does, right? Like you don't drive or relocate to an area to go to a better self storage property because of the school district, right? I mean, these are, you know, very hyper focused markets that rely on the 3 mile and 5 mile trade area. So, like, what is the population doing there? What is the growth? How is that property positioned on the highway? You can't just say, like, well, Dallas is a good market or Houston's a good market. You have to look and zoom in on that cross section and say, that's a good location because there's not a lot of inventory there. Um, I know that multifamily has been the topic has been supply, right? Too much supply, and coming into a market, we kind of we kind of have the same concerns on any given project, right? Where supply can kill a deal, right? And so I would say that that's a kind of a bigger thing. Our industry doesn't do a lot of floating rate debt, which I think makes us different because we're kind of dealing more with commercial loans. We're not dealing with Fannie and Freddie on the loan side, or we're not getting some kind of a loan that's backed by the government. We don't really have that. We have the SBA, but that's kind of a small segment of our industry. Most of our stuff's going to be fixed rate. Bank next door, regional local banks. financing it.
Most people we talk to feel stuck. They'll tell us things like, I feel behind. I wish I had more time with my family, or work is draining me. Does that sound familiar? The truth is, it's not that you don't want freedom. You just don't have a clear system to get you there. And without a system, what happens is 3 years from now, you're very likely to be in the same place that you are today. Your kids are going to be older and they won't care that your business was more successful. They'll just remember that you weren't there.
That's why we built the passive income operating system. It's the exact framework we use to design financial freedom for ourselves and for our clients, not decades from now, but today. Now, the system isn't free, but the training that shows you how it works is, and it's less than an hour. So go to infinitewealthconsultants.com/PIOS, PIOS, and take the first step to buying back your time, creating passive income, and designing the life you don't have to retire from. Okay, Ryan, when we were talking during our pre-interview, you had mentioned the 10, 30, 30, 30 investment framework.
Yeah.
Can you walk us through what that looks like and where does self-storage fit inside that?
Yeah. So it fits in a couple different ways, actually. So, when you mentioned, why go down this road? And, again, I was a airline pilot, high income earner. And my diversification strategy has always been 10, 30, 30, 30. 10% of your net worth, if you take your whole net worth, take 10% of it. That should be in cash and cash equivalents. Stuff like money markets that you can liquidate or have back to you within, the same day. 30%, the next 30% of your net worth should be in things like managed money, stocks, bonds, mutual funds, get some market exposure. The next 30% goes into things that you own and control, hard assets like rental properties, short-term rentals, Airbnbs, et cetera. Maybe you own your own self-storage inside of that bucket, up to you. That might be a little bit too much for people, and then the last 30%, it can be in things like syndications or real estate that's passive that you have the benefit of depreciation, the tax efficiency, but maybe you're not the operator itself. So that's kind of my 10, 30, 30, 30 strategy when I think about investing. So when I was getting those rental properties, that was kind of that second 30% bucket. I invest in a lot of other syndications. That's my other 30% bucket. And then I have, quite a bit of exposure to the stock, bonds, and mutual funds. That's 30% of my bucket. And then, of course, I've always got cash. Cash is making good money, but it's, a small part of my net worth is there for rainy day. And I'm not talking about like draining my savings down to zero or having a lot of savings, but, as a real estate guy, like I need to have liquidity,
Yeah.
to get loans and things like that.
Ryan, what does it look like? Like if somebody kind of walks in, becomes a new investor to Spartan, like what's the due diligence process look like for you guys? What are you guys typically looking for in a deal? And then also maybe what should a passive investor maybe ask
Yeah.
before they ever
I love
wire a dollar to you guys? What's a question or two?
Yeah, I love this question. So first of all, we put everything through a 700-point due diligence checklist. It's kind of an airline thing, right? We have a big checklist-driven approach to due diligence on our deals, and we've done over 100 storage deals, so we're very kind of dialed in on that. I think there's a gazillion self storage syndicators out there, right? There's a million multifamily syndicators. I think you need to figure out what's different, right? And I think, having a values driven business is huge. We're veteran owned. We have a big, emphasis on our mission, vision, values at Spartan. But also I think you have to look at the differences, like what is the benefit of the economies of scale that the operator has? Like we're one of the only platforms that has our virtual manager system that saves payroll. We also are vertically integrated, so we are our own property management company and construction. We've had 16 full cycle exits. We manage nearly $1 billion of self storage across 15 states. Our team is super experienced. We've got a guy that heads our operations with over 25 years in the industry. So I think these efficiencies matter, especially when they start reducing payroll costs per property, or they start leaning into an exit strategy, which is like, hey, these guys have a big portfolio, so the likeliness of them being able to sell to the bigger institutional players is huge. That's not just like a theoretical thing. If you own one property, like an institutional buyer is not going to come buy it. Sorry.
Mhm.
If you own a $1 billion portfolio, like you might be able to chop that up into $250 million chunks, so that means getting more per property potentially. So I think it's really important to kind of understand that. I think where I think my favorite thing as a passive investor to ask another operator is, you kind of start with, tell me about your worst project, right? And how it's going, right? And you ask this question first. You say, how's your word? Tell me about your worst project, right? And and if the person says, "Oh, we don't really have any bad projects," okay, then you just hang up and you're done, right? Because this is real estate, right? Like if you think that this is all going to go well, you're kidding yourself. Like you're investing as a passive investor in an operating business that has a ton of variables that make it go well and make it go sometimes not as well, right? So you want to hear that project, that challenge that they have. And then you want to ask some questions around that. And then at the end of that conversation, the very last thing you ask them is, "Do you mind if you connect me to an investor who's in that project?"
Mhm.
And you get a referral from that investor, right? And so then you hear about, how bad they think it was, right? And then you ask them for somebody who's in that deal, right? Instead of saying, "Hey, can you send me some, referrals?" And, of course, what are you gonna do? You're gonna go through your Rolodex, and you're gonna pick the top 3 people that are most excited about what they've done with you, and that's, of course, you're gonna get what the operator wants you to hear. But I think hearing from people who are going through the bad times and how you've treated that investor during that time, I think is highly critical, right? Because when it goes well, and who nobody cares, right? Usually going well means you're getting your distribution on time, maybe you're getting your K-1 on time, and you feel reasonably updated along the way. Like you have some sort of monthly communication that keeps you informed. So that's kind of where I would start. I think of it in terms of vulnerability, you know, and the more of it you get, the better, I think the better served you are.
And that's one of the common obstacles that people need to be careful when you're looking at these syndications. Everybody's going to have a great pitch deck or this great pro forma, but you really need to know, do these syndications fit into your personal buy box? And then also how to do the due diligence. And I will say, to help solve that, we have created what we call the Passive Income Lab, which is a coaching program that helps you build that buy box and it teaches people how to do their own due diligence so they can make sure they're getting in the best investment that fits for them. We'll have a link in the show notes. It's choosepassiveincome.com to learn more about it. But Ryan, can you walk us through a real investor example? Someone who came in, like maybe what was their problem, what the deal like, and then what was the outcome?
Yeah. So I would say most kind of the foundation of my podcast and most investors that come and invest with us is lack of diversity. So now airline pilots are making great money. And I think that most of their retirement savings is in a 401k. And so if you think about the defined contribution plans of the airlines, it's 18 to 20% of your paycheck, no matter what. You don't have to contribute. It's defined contribution. So it's going in no matter whether you like it or not. So you think about, a 400 or $500,000 income, you're going to max the $60,000 IRS contribution limit without even touching your 401k. And that's going to give you extra cash to invest. And I think that getting exposure to real estate is what the most wealthy investors do in the world, right? They get exposure to real estate. And I think that's what the problem is I think a lot of people don't want to do the active part of real estate, but they want exposure to it. And I think this is what problem I'm solving for people on a lot of instances. And then doing it in a really professional way, like having a vertically integrated team, a national brand, a group of experts that's really going to execute. And I think they also want to get educated in the process. Engineers, doctors, pilots, they want to know if I'm a drop of fuel, in a fuel truck and I enter an airplane wing and the fuel tank, I want to know exactly the lines that go through and the fuel pumps that touch it and how it goes until it blows out the back of the airplane, right? So they want to learn. They want to learn about how does this work? How do I get involved? How do I get better at this? How can I do my due diligence on operators and things like that? And I think that's the problem. Like that's the thing that we help people with. And ultimately they get into a deal and they get exposure to real estate investing and they get a K1 with a great tax loss, right? That might only be applicable to the income that that investment produces. But now I get the question all the time, like, what's the difference between making 8% in a stock and 8% in one of your deals? And it's like the tax efficiency, right, is so much better. And then they learn things about like infinite banking and, how you can use a life insurance policy to invest and you can get a better multiple or how you can use a short-term rental to deduct against some of your ordinary income, things like that. And I also help them choose the best bucket of which to invest. So I think, a lot of pilots come and they've got an old 401k from a prior airline, or they have a TSP from the military, or they have a bucket of cash in their taxable account, or they have a, life insurance plan. And it's like, which one do I use for which deal? Right, and because you can be very intentional about what money to draw from and where your money actually is and which one you can use for which buckets, and I think that's the biggest thing that we provide, and as an airline pilot, like, I get it, I did this for 17 years, I know what you know and don't know, and have developed all the connections to sort of help these people really, be immersed in what they're doing, so I think that's the biggest thing, and then, obviously, real estate is a get rich really slow. They do, 50K or 100K a year into our deals, and then the next thing you know, they've built up, some good passive income.
Mhm.
And I think the problem is, I think a lot of people don't realize is like your 401k is great, but you don't benefit from it until you retire. So real estate lets you benefit from the cash flow today, right? And the other thing is when you retire, your 401k just gets smaller as you withdraw from it to make distributions, right? Where real estate can continue appreciating and can produce cash flow. So it's a really powerful thing. And then the last thing I'll say is just, Roth versus traditional. I think a lot of pilots are, hungry for the tax break on the traditional investing, but there's a lot of strategies out there about how to move it over into Roth by reducing your taxable income and when do you do it and what's the timing. And I think this is where we're really kind of specialized in, not only, yeah, you can do our self-storage deal, but we're going to help you pick the best, we're going to help you plan for the best way to do it.
Ryan,
I like to add a little bit to
go
that
ahead.
is a lot of it depends on their goals. Like
Yes.
you'd mentioned, we have all this money in our government created plan. Can't use it till we're in our 60s, you
Yeah.
know?
Yeah.
And I would tell you, we actually work with a lot of pilots. Some of them are with an airline who's struggling right now, and they are having to move airlines. So they're losing their seniority and having to start from the bottom and work their way up. And if they had some passive income or maybe some income outside of their government created plan, it can help them during those difficult times till they build it back up.
Yeah. And if you think about it, I'm glad you said that. I mean, the airlines trick you every 10 years, right? 9/11, the GFC of 2008, COVID, right? So 10 years from now, what's it going to be? Right? Every 10 years, there's a massive disruption in the airline. And so that's what I learned really early on as a pilot. I would interview pilots when I was 19 years old in the airport. I'd pull them aside and say, "Hey, what advice do you have for me if I do this career?" And one guy said, "You got to have a lot of irons in the fire because you never know when this thing is going to go belly up." Right? Which is what you're talking about. I think I know the airline you're speaking of too. I think they just got a big bailout from the government, but we'll see how that goes. But one thing I tell those pilots that maybe are losing their jobs at an airline now, or they're bailing for a new one. What a great time to roll your, to take your traditional money and do a Roth conversion because you're never going to be at that low of pay in that new airline ever again, right? That's your lowest income you're earning year in your first year, right? And even better than that, put it into a syndication before you do that as traditional money. Take your old Spirit or whatever airline 401k, roll it into a self-directed IRA as traditional money. And then when you invest it into a syndication, you can actually get the appraisal knocked down substantially because of its illiquidity, right? You can mark it down 30% or so, and then you convert it in that low paying year to a Roth, and you can now have Roth money. Cause I think a lot of pilots don't realize, like, you're going to have mandatory distributions required when you're 72 years old for any money in your traditional. And that sucks, right? You don't want to be mandatory distributions and taxable event when you're 72. Like, why would you want to set yourself up for that? So anyway, so much opportunity there. I mean, it sucks getting laid off or whatever, having to jump ship, but there's a lot of opportunities hidden within there that can be have a pretty compounding impact later on. So,
Ryan, for some of your offerings, I heard you mention accredited. Are they all accredited? Are they all for accredited investors, or some of them for non? What are maybe some capital requirements that you guys have?
yeah, so we do have non-accredited investment opportunities, but you have to establish a relationship with us. So it requires us to have a phone call with you, get to know you a little bit better about your investing experience and background. But most of our offerings can be advertised, so that requires them to only accept accredited investors. But get to know us, like once a year, we'll do a non-accredited offering, maybe a smaller deal for those that we have a relationship with. So that's possible.
What about
Okay,
like
cool.
capital requirements? What's your typical minimum?
Typical minimums anywhere between 50 and 100,000 for our deals. For pilots, a lot of pilots do 50 because you can do a 401k loan, another great diversification strategy. Someone might be heavy in the stock market and it's a great way to, pop out 50K. And it's a great way to put more money in your 401k actually, because the interest you pay yourself goes into your 401k. So it's kind of a backdoor way of getting an extra $7,000 or so in your 401k that year.
Ryan, when we had talked, you had actually used your own whole life policy to fund some investments. Can you walk us through how that worked in practice and what did it look like the first time you borrowed against your policy to get into that deal?
Yeah, well, it's interesting. I would probably say 50% of the pilots I talk to are doing this,
Okay.
which they're using a whole life policy and then they're borrowing against it and then they're investing in a deal. And you guys know this well, but let's say you have a whole life policy and there's a cash value of 100,000. You can, let's say your plan is paying, 5.75 interest, in your whole life policy, 5.75%, and you find a loan for 5.25%. Well, your plan is going to still pay you that difference, right? So your whole life policy will still net you a half a point on 100 grand. But even that loan that you take is now all yours. That 100 grand is still working for you at 5.75% on a 5.25% loan. And now you can invest it in a deal. So now you're like earning an extra half a point, just for doing the whole life strategy, which is amazing. And then you just call up your provider or you can go to a bank and get a loan. In my case, we just borrowed directly from our provider and put it into a deal. And, it came with a little resistance from the gentleman that runs our plan because he is incentivized, I guess, to not allow loans against policies. But we did it anyway because I think it's awesome. And, we got to invest in a deal that, that maybe we would have otherwise, we still could have invested it with our regular cash, but it was just, more lucrative to do it with a whole life plan. Not to mention you still get a death benefit, which is pretty cool. And for pilots, like a lot of airlines give you a term life policy, right? But that goes away when you leave the airline. That doesn't go with you. That's non-transferable. So, I mean, think about it. If you get laid off or you could be like, oh yeah, I have a great life policy through my current airline, but then all of a sudden the airline goes bankrupt and you're on the street and you're now, 55 years old. and you're hoping for having a term life for another 5 years. And I mean, imagine what the cost of a term life policy is for a 55-year-old versus a 30-year-old or whatever it is. So it's going to be a little more difficult to line that up. So I think a whole life policy is a great strategy for investing, and really, and even I know the death benefit sometimes is minimized, but it's still pretty nice to have that sitting around.
So Ryan, I got a question for you. Your agent was not a big proponent of borrowing against a policy. And there are some insurance companies that are great insurance companies, but they're not open or conducive to infinite banking. And so their agents aren't really there promoting it. If you're getting some resistance, so obviously he or she didn't give you the idea to use your cash value. How did you get the idea?
Yeah, I mean, just listening to podcasts,
Okay.
and educating
Like the
myself.
Infinite Wealth podcast. Great
Exactly.
plug
Yeah,
for us.
listening to your show. I mean, and just kind of because honestly, the topic is confusing, right? I mean, calling it infinite banking, calling it these different things. I do kind of feel like it's a little bit. It sometimes comes off as like a marketing thing or a sales thing, but when you kind of peel it back, it's pretty straightforward. It's you have a policy that you should set up with somebody who has your end in mind, like the 2 of you guys, right? Like, you gotta have somebody who's designing a plan and getting a structure that aligns with what you intend to do with it. And I think too many times, you might find somebody who offers a life insurance policy that has a plan for what works best for their commission, not necessarily what works best for what you're trying to do in investing. And so, I think it's really important to work with the right person that's gonna have your kind of end goal in mind. And so a lot of pilots, I mean, I know, they have terms, so they're kind of all good there, right? And they're just looking for this whole life thing that's gonna maximize cash value and optimize borrowing against it. And I think that's, and maybe that's not your goal as a pilot. I'm not saying all pilots have that goal, but generally my listeners of my podcast have that goal in mind. And my investors that use the policy have set up a policy or a plan that's conducive to that.
Ryan, I got a question for you. It's a little bit obvious, but I want to make sure that I ask this is if somebody comes and approaches Spartan, right? Do they have to be a pilot? Right? Or does it open to anybody and
No, no,
everybody? And if so, is there
no.
anybody that it may not be a good fit for, right?
Yeah, no, I mean, I think anybody can. Yeah, most of our investors are not pilots. To be clear, like we have more investors that are not pilots than there are pilots. It just happens to be what kind of a fun background and more relatable too. But no, I mean, I think any high income earning investor, I think is welcome. And I would say if you need to know every detail and you need all the control and like to pick out the paint colors, like you're probably not a good fit. Um, if you are looking for something that's truly like, I could go into a coma for 5 years after I give you money and come back and it's performing better and that's what you want, great. If it's, hey, I want to know everything and visit the property every week and get my hands on it, like probably not a great fit. I mean, you could still be an investor, but you're probably not going to enjoy the ride very much. Because that's just it's just not what it is. It's yeah, we share all the details. You get the full financials every month. You get the move in and move outs. You get the the details of the loan and things like that. But you don't necessarily get the decision making that you'd otherwise get in your own active deals. And I think those people know and self-select out pretty quick.
Ryan, you're doing a great job, man. If somebody's listening, they're interested, where's the best place that they can connect with you at?
Yeah, our website's spartan-investors.com. You can also email me, Ryan at spartan-investors.com.
You guys are listening. Make sure you register for July 15th. We're bringing Ryan back. He's going to dig into a deal and kind of show you some of the numbers and expectations. So, Ryan, again, thanks for your time today. Really appreciate coming on.
Thanks for having me.
Thanks, Ryan, and go make a fantastic day.
Take care.
The opinions expressed on this podcast are solely those of the hosts and guests and do not constitute financial advice. Always consult a licensed professional for professional decisions.
Thanks for listening to the Infinite Wealth Podcast. If you enjoyed today's episode, be sure to subscribe so you don't miss future conversations on building wealth and creating passive income.
You can learn more about Infinite Banking and get additional resources at infinitewealthconsultants.com. Until next time, keep investing with intention, and remember, your financial freedom is within reach.